Friends, our today's topic of discussion is insurance. So, in fact, we are going to discuss various products available in the insurance sector. We will be also discussing what is insurance and what are the principles of insurance, what is the nature of insurance contract. All these things we are supposed to discuss. And before we enter into that concept, we have already covered a topic on banking sector. So by this time, we know that banks plays a very important role in the financial system of the country. People have confidence on the financial system because they trust banks. So banking sector plays a very important role, no doubt about it. Similarly, there is one more sector which also plays a very important role is insurance sector. Okay, various insurance companies are there in your country. You might have heard some of the names. Can you tell me some of the names of insurance companies? Quickly, these are the insurance companies. Can anyone tell me names of insurance companies?
GIC.
Sorry, a little louder.
Sir, LIC, GIC.
LIC, Life Insurance Corporation of India.
So in NISL.
Sorry, tell me the
NISL.
complete company's name.
Sir, General Insurance Corporation.
Please check it off if that's a entity or not. Then what else? Yeah, please tell me some of the names of insurance companies. Those who are not participating, Bharata, please mute yourself. Yeah. Others, please tell me some of the names of the insurance companies.
So Tata AIG.
Okay, Tata AIG. Then what else?
Sir,
ICICI.
Yeah, please tell me once again.
So Bajaj Allianz.
Bajaj Allianz. Okay, right, like that. Various insurance companies are there. So they sell various kinds of different kind of insurance products are there. The purpose of all these products is that, or you can say the objective of this product is that why we buy this product, because through those products we the people are able to reduce our risk or we are able to manage our risk. So this insurance product helps a lot in managing the risk. So in any financial system, when people invest money or people do some kind of financial transactions, definitely they take a lot of risk. So there is a need that this risk needs to be managed, and this management of risk is possible through this insurance product. Okay, so insurance in fact helps us in risk management, right? So that is why this particular topic is important for us. So if someone wants to participate in the financial sector, he needs to know what is the risk he's going to take, and if there is some ways to minimize that risk, that also one should know. Okay, so welcome you all to our today's classroom deliberation. So today our plan is to discuss all these things. We'll try to understand what is the definition of insurance, what is the function, what is the nature, and what is the character of insurance. We'll be trying to discuss, and if time permits, we'll be also covering the principles of insurance. Okay, so let us first of all see what is this concept, what is this insurance. So, in an insurance contract, what happens when people pay some money? That money is called as premium. Popularly, that is called as a premium. You know that thing. So, some of you in your house, your parents might have taken house, let us say, life insurance. Those who are having vehicle must have taken a motor insurance policy. Okay, and there are many other kind of policies are also there. Suppose business houses, they take fire insurance policy. So various specific policies are there. These policies are meant to cover some specific kinds of things. And what happens? The policy holder pays money. One more popular insurance you must have heard of is medical insurance or health insurance, right? What happens? The person who is going to take the policy pays money called as the premium. And on receipt of that premium, the insurance company offers a policy. In fact, there one sum is decided that is called as the sum assured. In case happening of certain event, that sum assured will be paid. or the insured will be compensated. So that is the system that happens in insurance. So if you look at here, if you look at this slide, the first point talks about it provides financial protection against loss arising out of happening of certain events. Right? For example, you think an example. Suppose you have taken a health insurance policy. If nothing happens, then good, you are not getting any compensation also. But in case you get admitted in a hospital for whatever reason, so there will be some financial loss, and that financial loss is protected with the help of insurance policy. Okay. Similarly, let us say you are having a something like vehicle insurance policy, and the vehicle meets with an accident. So that will bring some financial loss. That financial loss can be protected with the help of an insurance policy. Okay. That loss can be protected. That loss can be minimized because insurance company is going to compensate you for that loss. And this protection is available on payment of a sum which is called as the premium. When you have taken a vehicle insurance policy or you've taken a health insurance policy, then you must have paid or you must be paying premium on that policy. On receipt of that policy, that insurance company undertakes to compensate you. Okay, understood this, how it happens? Each policyholder pays money called as a premium. And through this premium, a common pool of money is created. Out of that pool of money, compensation is paid. Okay, let us say you have all of us are paying premium. Let us say policyholders, let us say various number of policyholders will be there. So 1, 2, 3, 4, 5, so many policyholders are there. All of them, they pay money. Everybody pays premium. Premium comes everywhere. And a common pool is created. Pool of fund is created. The insurance company is the trustee of this insurance company. It is the trust. It manages the and it is natural or with the principle of probability, loss will not happen to everybody. That is, if somebody suffers a loss, then he will be compensated out of that. Insurance company will be. Insurance company will be managing this pool. Insurance company may invest that pool. Insurance company may maximize the wealth of that pool. But if someone suffers a loss, then he will be compensated out of that pool. This is the normal procedure. This is how insurance works. Okay. This money is called as premium, and everybody has taken a policy, and there is a sum assured. Sum assured will be paid. Understood the system? Now, a pool is created through contribution made by the persons seeking to protect themselves from a common risk. So normally what happens, all these people who take that insurance, one thing is common, that risk is common. Okay, suppose everybody is taking a health insurance, that means everybody is exposed to some kind of health risk. If everybody is going for a vehicle insurance, those people who have taken the similar kind of policy, they are exposed to a similar kind of risk. Okay, the premium which is collected by insurance companies are kept by the company in a pool, and the company acts as a trustee to the pool. And in the event of happening of certain uncertain event which is insured against, the money out of this pool is paid to the person who is suffering from financial loss. Okay, that means how the system works. This is working on the principle of risk sharing. The risk is for all, but the now risk is shared. Okay, so many shareholders are there. They have distributed the risk among themselves. In one person is, in fact, what is happening? One person is suffering, and everybody is contributing because no one knows who will be suffering. Who will be suffering from? No one knows that. Is it? That is uncertain. So that is how this insurance works on the principle of risk sharing. Or in other words, you can say the risk is spread in the entire community who are exposed to the risk. Okay, so this is called as the spreading of risk. So this is how it happens. This is how insurance uh, is operated. Is it clear to you how insurance happens? Yes or no? Did you understand this concept? How insurance products are designed? Insurance products are designed in this manner. So you'll be understanding that concept also, product designing of the product. But right now, I think you have understood the basic concept. Now, having understood this, let us try to define the concept of insurance. Let me share it though. Next slide, which talks about the definition. Okay. Maybe we'll be defining it multiple ways. First, one way we'll try to understand it. Insurance is a cooperative form of distributing certain risk over a group of persons who are exposed to it. So as you have seen the concept, what happens? It is a cooperative form of distributing certain risk. Everybody is exposed to this. The entire group who have taken the insurance policy, they are exposed to similar kind of risk. But through this mechanism, the risk is distributed among them. Okay, everybody is sharing the risk. That's why it is called as the cooperative form of distributing certain risk. Okay, few people may face that risk, but that risk is distributed among the entire group. Another way of understanding it is that insurance is a contract in which a sum of money is paid to the assured as consideration of insurers incurring the risk of paying large sum upon a given contingency. Meaning, if certain contingency happens, if some defined contingency happens, or you can say, if some already decided accident happens. Okay, what is the subject matter that is called as the contingency? If that thing happens, let us say you have taken a health insurance. Let us say you get admitted in the medical. So that is the contingency. So in the happening of that contingency, a certain sum, which is called as the sum assured, will be paid. Okay, so this is a contract under which the sum assured will be paid to the insurer. But upon a consideration means insurer has to pay something that is called as a premium. So it is a contract in which a sum of money is paid. Sum of money is the sum assured. Sum assured is paid to the assured. Assured means the policy as consideration of insurers insuring risk and paying a large sum upon a given contingency. A contingency happens, premium is received, and under this contract is paid as compensation. We may define insurance or we may describe insurance as a social device whereby a large group of individuals through a system of equitable contribution may reduce or eliminate certain measurable risk. And here risk means we're talking about the financial risk or economic loss, which may be common to all members of the group. So it is a social device. As you can see, people who are exposed to similar kind of risk are coming together and taking a policy. So by doing so, they are able to reduce the risk or maybe able to eliminate the risk. But actually the contingency is not removed. Okay, or you can say the accident or the subject matter for which insurance is taken, that cannot be eliminated, but the risk can be eliminated in the sense the financial loss part can be eliminated. Okay, these 3 points talks about, or these 3 points tries to define what is insurance, but a better definition will be like this. So if you go through this definition, it clarifies exactly what is insurance. If you say, if you read it, it's like this. Insurance is a contract between two parties. So first of all, we have to understand what is insurance. It is a contract. So some of you might have studied contract law, contract act. So you know what exactly the meaning of contract. Meaning it is a legally enforceable document. It's not just an agreement. It is a legally enforceable agreement. So it's a contract between two parties. The two parties are involved in any insurance contract. Okay, one is insurance company, another is the policyholder. Or you can call the insured and insurer. Insured is the policyholder and insurer is the company which provides this insurance service. It's a contract between two parties, whereby one party agrees to undertake risk. Now tell me, which party agrees to undertake the risk? Can anyone tell? Two parties are there. One is insured, that is the policyholder. Another is the insurer or insurance company. Who is taking the risk? Sorry?
That company.
That company or the insurer is taking the risk. One party agrees to undertake the risk of another. Of another means other party's risk. Actually, it is the insured's risk, but other party undertakes that. In exchange for consideration known as premium. In exchange of consideration. So when someone is taking the risk, he is taking the risk for a consideration, okay, for certain money. And that consideration is called as premium. He takes premium and undertakes the risk. And by doing so, he promises to pay a fixed sum of money. He promises, if this thing happens, I will pay you this to another party. Another party means to the insurer. On the happening of an uncertain event. Suppose some uncertain event happens. Uncertain means you do not know actually when it will happen. To what extent loss will be there, you do not know. Happening of an uncertain event, for example, death. In case of life insurance, it's death. Or after expiry of certain period. Let us say death doesn't happen or that uncertain event doesn't happen. Still, the company may pay after expiry of certain period in case of life insurance. Normally, life insurance policies are like this, right? It is not only for risk coverage, it is also for investment. Suppose if nothing happens, still you can get a compensation. You can get the match sum assured. So certain sum of money will be paid on the happening of certain event or after expiry of certain period. Or to indemnify the other party on the happening of an uncertain event in case of general insurance. In case of general insurance, only when the uncertainty happens, then compensation will be paid. If it doesn't happen, nothing will be paid. Okay, let me tell you difference here. What happens in case of life insurance? Okay, if death happens, compensation will be paid. If death doesn't happen also, after certain period, when on the maturity of the policy, some asset will be paid. Okay, normal kind of policy we're talking about. Of course, when we're learning various types of policy, we'll be learning different kind of policies with different characteristics. But the normal life insurance policy that we normally take, it is endowment plus risk plus investment kind of policy. In that thing of what happens, even if death doesn't happen, on the maturity of the policy, some assured will be paid. But in case of non-life insurances, compensation will be paid only when the uncertain event happens. If it doesn't happen, then nothing will be paid. Okay, so because this is not an investment contract, that's a contract to cover risk. Okay, so this is a major difference between life insurance and non-life insurance. Are you getting me? Did you understand this?
Yes, sir.
Now, if you see, this paragraph actually defines in a better way what is insurance. And here you have to understand the party bearing the risk. That means the person who is taking the risk is called the insurer. That is the insurance company. Or you may call it as assurer. And the party whose risk is covered is known as the insured or assured. Now you have understood what are the two parties. Who are the two parties? One party is insurer, other party is insured. Okay, suppose you are taking a policy, then you will be called as insured. And the company who is providing you that policy, that company will be called as insurer. Company is the insurer and you are the insured. Is it clear to you? Right?
Yes, sir.
Now, we'll be learning about the concept of insurance. But before that, let us appreciate that insurance is not a very new concept. Don't think that it has only recently developed. Of course, now we are seeing a lot of insurance companies. Substantial growth has happened in the insurance sector. But the concept is very old. Okay. Whenever there is a, you can say, major uncertainty happens, so people think of some solutions to that. And earlier days, it is believed that when people are going for trading in ships, right? Many people go out in ship to do the trading. At that time also, they used to take loan and they do the business. And at that time, they were entering into a contract, and where there was some terms that in case the ship sinks in the sea, then the loan will not be recovered. So this kind of contract history shows this kind of contract was there long back. So that is, you can say, that was a kind of insurance at that point of time. Of course, nobody has thought of something called as an insurance company, but this kind of system was there when people are protecting themselves. So if the ship sinks in the ship, then loan will not be recovered. So that kind of insurance they are having. Subsequently, many things happens. What the people say, the Great Fire in London happened somewhere in 16th or 17th century. So at that time also substantial growth happened to the insurance sector. And many insurance companies have developed nowadays with varieties of policies. Now, let us move to understand this various concept of insurance. Let us understand how exactly it works. Now you have understood that a group of people are involved in any insurance product. And this group of people are exposed to similar risk. Okay, and they together make contribution. Suppose all of you are driving a similar kind of two-wheeler. So you are exposed to a similar kind of risk. Okay, so you can come together, or the insurance company helps in bringing all of you together and collecting some money by your premium and creating a common pool, so that if actually someone suffers some financial loss, then he will be compensated out of it. Okay, so always contribution is made by the group who are exposed to similar kind of risk, and a common pool is created and managed by the insurance company. Okay, so to understand that, let us take an example. Now you can look here. Suppose in a village there are 1,000 houses, and the value of one house is how much? For example, we are taking it 40,000 rupees only. And history shows the possibility or the probability of burning a house in a year is 5. That means normally on an average, on yearly basis, 5 houses may catch fire. So annual loss total comes to 5 houses into 40,000. How much it is? 2 lakh. Okay, so 2 lakh will be the annual loss. Okay, now how to compensate that loss? Then all these people can come together. If 2 lakh is the annual loss, then totally there are 1,000 houses. So fourth house, it comes to 200. If 200, every house can contribute, then a common pool of 2 lakh can be made. And if in case there is some loss, out of this common pool, compensation can be paid. Okay, here 1,000 houses are exposed to common risk of fire. And it is possible to create a specific policy for this by creating a common pool like this. This is how insurance products are developed. Are you understanding this example? You understood it, or you need elaboration?
Yes,
Understood, sir.
sir, understood.
Okay. Now, procedure is very simple. Each owner will contribute 200 as premium. In case loss happens, then he will be compensated. If loss doesn't happen, then nothing will be paid to him. The total value of the fund will be 2 lakh rupees. In case some of the houses burns during the year, then they will be compensated after this. That means exactly what happens. the risk is for 5 houses, but no one knows which are those houses. The risk of these 5 houses are spread over 1,000 households. Okay, so this is the process of risk spreading. Risk is spreaded. Okay, and since everybody is sharing premium, it is called as the cooperative device. Insurance is a cooperative device. It's everybody joins hand, and with this, they are able to spread the risk. The entire risk is distributed among a group of people. Okay. Now, one more example we'll take about life insurance. Here you take an example. Suppose there are number of persons are 5,000, right? And their age and physical condition, because different age groups are exposed to different kind of risk. So we're saying that around 50 years of age, or the age group is around 50, and the mortality table or the history shows that the number of persons dying in a year is 50. So out of 5,000, 50 people will die. And if you compute the economic value of the loss suffered by the family of dying person, it's 1 lakh. That means if one person dies, the economic loss will be 1 lakh rupees. These are examples only. The annual loss due to death will be how much? 50% are maybe dying. So total annual loss will be 50 lakh rupees. And this group, in the group, there are 5,000 persons. Now this 50 lakh rupees will be covered from these 5,000 persons. So each person should contribute 1,000 rupees as premium. That is the concept. If 1,000 rupees everybody is contributing, then a pool will be created for 50 lakh rupees. And in case somebody dies, this economic loss support can be compensated out of that. Okay. But here assumption is that this 5,000 people are exposed to a common risk. That is why the life insurance company creates age groups with the belief or under the assumption that exposed that they are exposed to a similar kind of risk. Okay, so that the premium collection will be fair. They're exposed to similar kind of risk, they're supposed to pay similar premium. This is how this system works. Okay, here what happens? Everybody contributes 1,000 rupees. Say fund value becomes 50 lakh rupees. 50% dies, everybody 1 lakh. So they get 50 lakh rupees. Okay, so the risk of 50% is here spread over, or spread among 5,000 people. So therefore, the risk burden is reduced. Per person, risk is reduced. Okay. I think you have understood the process of this. Yes or no? Having understood
Yes,
this,
sir.
yeah,
Yes, sir. Yes, sir.
this, yeah. Now we'll move to learn various functions of insurance. We are classifying the insurance functions into 3 categories. One is primary, second is secondary, third one you can say other or miscellaneous functions or incidental functions you can say. So let us take a list of these primary functions first of all. First of all, as you have understood now, the primary objective is to protect risk. So insurance policies provide protection against this. The financial loss, the losses are protected. So in reality, insurance gives a protective cover against economic losses. If you feel there will be some financial loss, if you feel in case you suffer some health issues, you will be incurring financial loss, or if you feel your vehicle meets an accident, you will be incurring some financial loss. So you can take a policy and you can protect yourself from that financial loss. Okay, non-financial losses cannot be protected, but financial loss can be protected through insurance policy. Right. Okay. One more function is that collective risk bearing. This what exactly happens? The financial losses that few people are suffering, that is spread or that is shared among a major group. Okay, so insurance act as an instrument to share the financial loss. Since everybody is contributing by way of premium, but everybody may not suffer loss. So through this mechanism, what exactly happens? Collectively, the risk is shared. So one more function is collective risk bearing. Insurance also helps evaluating the risk. So when you take the policy, you decide at that time, you got an option to decide the value of the risk. Suppose you feel if the vehicle gets stolen, how much you need to be compensated. You decide. So through that, in fact, what exactly you're doing, you're trying to evaluate the risk involved. So that is one more function. Insurance fixes the likely value of the risk by assessing various factors that gives rise to risk. So indirectly, you also assess the risk. What is the probability of the theft you assess? Accordingly, you take the insurance cover. Okay. And through insurance, what happened? Uncertainty is converted into some kind of certainty. That means you get assured if this thing happens, it is almost certain that you'll be compensated. Right. You exactly before that, you may not be knowing what will be the exactly loss, exact amount of loss, but now you know you will be compensated if that is there. So insurance provides a kind of certainty. You get assured that up to this much, at least you are certain. Suppose you have taken a health insurance policy and you know that in case I get admitted in the hospital, so I'll be compensated. Let us say at least up to 6 lakh rupees. Not to worry because my policy coverage is 6 lakh rupees. If anything happens, it will be taken care of by my insurance company. So to a large extent, uncertainty is converted into certainty. So these are, in fact, the primary functions. Coming to secondary functions, insurance prevents losses. Losses means through that, you can say, the policyholder, when he approaches and goes for an insurance policy, he gets a warning, or he himself assesses that he is exposed to these kind of risks, and there is a need to get protection against those losses. Okay, so insurance in fact warns the individuals and the businessmen to embrace appropriate device to prevent those risks. So it gives a kind of warning. It indirectly assesses the risk. And with the help of insurance, large risks, bigger risks are covered with small investment because the premium is always less. Why premium is less? Because the risk is spread over a larger group. So even if the possibility of the loss is bigger, insurance premium amount is smaller. It helps the development of larger industries. There are many industries, there are many businesses where risk is high. In that case, insurance gives them the opportunity to enter into those ventures and to cover that risk with the help of insurance policies. When insurance policies are there, they feel protected because the risk is covered. Okay, and coming to other functions of insurance, it is also a saving tool, specifically in case of life insurance policies. So even if the uncertain event of death doesn't happen within the policy period, when the policy matures, the money invested is returned back with some return, additional return, with some, let us say, bonus money, etc. So it is also an investment vehicle. It's an investment option. Again, insurance is also a source of earning foreign exchange. Many insurance companies in our country are also exporting their services. So they also promote international business. And through insurance business, it is also possible to promote export business because export risks or international business risks can be insured with the help of insurance policies. Okay, there are various institutions who specifically cover this kind of risk. So these are some of the incidental or additional functions which are performed by insurance companies. Okay, friends, in fact, today you understood what is insurance and how this works, how insurance works, and what are the functions of the insurance. We'll be covering the other issues like nature and characteristics of insurance and principles of insurance in our next session. Okay, today we'll stop here with this concept. We'll be continuing next class with some more issues. If you have any query, let me know very quickly. Else we are going to wind up the session. Any query you have?
No, sir.
Okay, thank you. We'll catch up in your next class.
Thank you, sir.
About the nature, character, and principle.
Thank
you, sir.
Thanks a lot. Thank you very much. Thank you.
Have a good day, sir.
Thanks. Thank you.